Good evening, everyone. I don't know, we had some sound problems. Now everything is fine. So today we will talk about Tom DeMark trend lines, and I wish welcome to all members of this webinar and all traders. And this webinar will show you how Tom DeMark effectively traded trend lines. And I will give you my opinion about this. So pay attention to this because it's a pretty much different to anything that you have seen so far, okay? So let's talk about Tom DeMark trend lines, and before we begin, as always, our standard risk disclaimer. So first of all, risk disclosure statement stating all possible risks associated with Forex market. By accepting this risk statement, you're also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Okay. Admiral Markets UK Ltd takes no responsibility for information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So, we will do a quick reminder about what are trend lines. Then we will see what sort of trend lines we use in trading. Then we will, of course, talk about Tom DeMark trend lines, then how to create Tom DeMark trend lines step-by-step guide, okay? Then differences in approach between classic school and Tom DeMark trend lines. We will definitely talk about it also. And I will give you my opinion, what I think about these trend lines and how you can effectively trade it, okay? Now, first of all, we need to do a bit of reminder about trend lines. It will be quick, then we will move to Tom DeMark trend lines. So, first of all, trend lines are a visual representation of support and resistance in any given time frame. That is a classic definition of a trend line, and that is definitely true. So trend lines are a visual representation of support and resistance in any given time frame. That is a line that is usually drawn over swing highs in downtrend or under swing lows in uptrend to show you the prevailing direction of the price. Trend line must have at least 2 touches to become valid. The more touches it has, the more valid it is, okay? That is also the truth. So these are the postulates about trend lines. The more touches it has, the more valid it is. The more touches the trend line has, the more powerful the move after a trend line break. Long trend lines are more important than short ones, and shallow trend lines are more reliable than steep trend lines, okay? So we already talked about this, and you probably remember this webinar, but we need to make sure that you can differentiate between classic trendline school and Tom DeMark trendline school, and there is pretty much a lot of difference between classic school and Tom DeMark school, okay? What sort of trend lines we use in trading? As you already know, I use inner trend lines a lot. You can find inner trend lines in my analysis, and you will see what Tom DeMark says, but definitely I use the other approach. But I will tell you, I will teach you how Tom DeMark trades, and this was the analysis which was basically done today. You see, after this, the price jumped up, then it jumped off this support. So basically, these trend lines which we use are classical trend lines. So I belong to classic trend line school. But I'm not saying that Tom DeMark isn't right about few things, but definitely I do not agree with all he teaches. That I think that most of classic trend line mentors and classic trendline traders definitely use this old and good approach. But I'm not saying that Tom DeMark isn't right about it. I need to say that in current market conditions, it's pretty much hard. And we will see why. So I'm not saying that you shouldn't try to trade how he trades, but definitely I will pass that knowledge to you as much as I can in this hour. But definitely, there are some things that need to be worked out before you start trading it live. So inner trend lines, intraday trend lines, intra-week trend lines, and of course intra-month trend lines, which are mostly intra-week trend lines, which have a bigger time span. Let's say an intra-week trend line is a trend line which is usually 7 to 14 days long, and intra-month trend line is everything which is 14 plus days. So you usually connect 1 or 2 months with it, or if you trade higher time frames, even more. Now let's talk about Tom DeMark trend line. So for all of you who are still new to trend line approach and to classic school of trend lines, I definitely advise that you watch one of my webinars, and I think that also Chris and I did a mutual webinar about classic trend lines. You can find it under trend lines and channels also. So now we will tell a few things first to introduction, how Tom DeMark basically how he sees trend lines and generally price movement. Supply and demand create price movement. That is the truth, because in classic economy school, supply and demand are definitely things which move the price and move the market. So supply and demand create price movement. That is definitely the truth, and when supply exceeds demand, price declines. That is always. So should supply exceed demand, price declines. Should demand exceed supply, price advances. It goes up, right? That is also, you can, even if you're not, if you haven't graduated on economics, these are the things that are basically made, they're making up each standard economical market behavior. So the law of supply and demand. So in order to picture supply and demand on the chart, we usually draw ascending line to represent demand and descending line to represent supply. Okay, so there is ascending line, and there is ascending trend line, and there is a descending trend line. So demand and supply. Okay, the difficulty, now we go to the difficulty in constructing these trend lines. It definitely becomes apparent when choosing the specific points to select and to connect, creating those trend lines. So there are definitely some difficulties which traders will come when they construct those trend lines. But the thing is, you shouldn't be bothered with that, because constructing trend lines in classical approach is much different than Tom DeMark approach. But the thing is, Tom DeMark, now you need to pay attention, because we will go step by step. He does that in a pretty much different way. So this is the most important for you to remember now. Tom DeMark uses different approach than the standard one. Okay? Okay? The primary thing which he focuses his knowledge about and charting trend lines is that recent price activity is more important than historical. Now, I would definitely object. This is my opinion, because for me, how I do it, historical price level is way more important than recent price activity. I know that can sound strange to some people, but definitely, you know, a price tends to repeat itself. And that is what I always use in my analysis. When I see that, let's say, this level here was pretty much tested a day ago or a week ago or a month ago, and the price is trying to reach this level, I know that this level has some confluence to the price, because this level will definitely give you a scalp trade at least. So it has some connection to the historical price. And very often when we find important, I always say important support and resistance levels, historical support and resistance levels, we then try to find a confluence in those levels with other chart patterns to see if we can get a trade here. Okay? So I cannot definitely agree that recent price activity is more important. But now, for the course of this webinar, everything which I will be telling you will be from the perspective of Tom DeMark. So please pay attention to this. I'm not saying that that is my opinion, so I'm just passing the knowledge of Tom DeMark. So he says that recent price activity is more important than historical. Traders should read the charts from right to left, like Japanese do, from right to left. So we don't, on Tom DeMark approach, we do not read the chart from left to right. We read the charts from right to left. Because as he says, recent price activity is more important than historical. Okay? Now, how to create Tom DeMark trend lines? Of course, this is now the approach. This is so-called manual approach. I will show you the slides. I will explain you how to locate the 2 points. But definitely, I have an indicator which plots Tom DeMark trend lines. So for all of you who are interested to have this indicator after the webinar, as always, you can mail me and I will send you the indicator. So there won't be any problems. It's free. It's not copyrighted at all, so I can definitely send it to you. Okay? Now what Tom DeMark says is we should first locate the 2 points to create the trend line. Okay? An uptrend is created when demand exceeds supply, and downtrend is created when supply exceeds demand. Okay? Now, when choosing now let's talk about let's say uptrend. Okay, this is uptrend example. When choosing the points to create a demand line, that demand line is basically an ascending trend line. Okay, that is what Tom DeMark calls the demand line. Okay, so that is basically a standard ascending trend line. Okay, and when choosing the points to create a demand line, we are focusing on points of support. So definitely the points of support. Okay, the lows of the price. True points of support are only those which low has 2 candles to the left of it and 2 candles to the right of it, which lows do not exceed the low you are using. Okay, I will also show you that later on the chart, so let it not confuse you at the moment. I know that it can sound a bit confusing, but you shouldn't be confused. I will show you. Then first you need to locate 2 points, so you need to find point 1 and then locate the second point, which is basically point 2. But you don't do it from right to left, you're basically doing from left to right. Okay, let's say that you see that this is the price low, okay, and let's see that this is the second low of the price. So you do not connect basically from left to right. You first locate 2 points. So this is the first point, this is the second point, and you connect it like this. Okay? You connect it from right to left. So to find the second point of demand line, we look for the very next point of support. It has 2 candles to the left and 2 to the right that do not exceed the low of the support point. Okay? So that should look like this. So we first create this trend line. Okay, this is what the indicator plotted automatically. So this is point 2, 1. This is point 2. They were connected, but you know the indicator plots it standardly. But that is definitely how Tom DeMark teaches you to do. And you now can ignore this upper trend line because we are talking now about this demand trend line. Okay. And then when you created the Tom DeMark trend line, you need to find price projection. We are now talking about uptrend, okay? So we want to take a breakout of the lower trend line. Take the highest high created above the trend line and mark it with a vertical line. I will show you the slides. Now please concentrate and snapshot these charts if you want to have it for yourself. Okay? Now we will see how Tom DeMark trades breakouts of ascending, or how he calls it, demand trend line. Okay? Take the highest high created above the trend line and mark it with a vertical line. Then take a horizontal line and mark the point where the vertical line coming from the highest high recorded above the trend line intersects with the trend line. Take the difference between the highest high recorded above the demand line and the point where the demand line is intersected by the vertical line. Okay? Pay attention to these guys, okay? Now, when you see that happening, you will do that on your chart, okay? What did we say? Step by step. Take the highest high created above the trend line and mark it with the vertical line. So we trade this approach. So this is Tom DeMark trend line. This is Tom DeMark trend line, okay? We have lows, even we have 3 lows. He says 2 lows, but in this example it's perfectly fine to have 2 lows, okay? Because we started from point 1 to point 2. Now this is the point 1 and this is point 2. Even though there are 3 points, but 2 points are enough, okay? Now we take the highest high created above the trend line, and this is definitely the highest high because this is the last point. And if we take this price projection into account, we have definitely a high within this range. And this is the high. So take the highest high created above the trend line and mark it with the vertical line. So we mark this high with the vertical line. The line says it's 24.85. Okay, this is the high. Now, take the horizontal line and mark the point where the vertical line coming from the highest high, this is vertical line coming from the highest high, recorded above the trend line, intersect with the trend line. This is the point of intersection. Now, you can see that this is very different approach to trading trend lines. And this is how he calculates the target, okay? There are no pivot points. There is no additional indicators. There is only Tom DeMark trend lines. Okay? And this is the intersection point which was marked at 23.90. Okay? I will repeat it once more because this is one of the most important points when you want to trade Tom DeMark trend lines. Okay? Definitely one of the most important points. So, again guys, take the highest high created above the trend line and mark it with a vertical line, okay? That is the first step. You always need to determine the price projection. So this was the high which was contained within this trend line. When we draw the trend line, this was the point 1, this was the point 2, but then the movement went back, and now we don't do it like that because this is point 1, this is point 2. And the high within this price is here. It's 24.85. Then this vertical line, this horizontal line, okay. This, sorry, I have a lot of Twitter messages. I will definitely put my mobile on mute. So horizontal line, this is the horizontal line, okay? And you mark the point where the vertical line, okay, coming from the highest high above the trend line, intersect. Mark this word, intersect, guys, with the trend line. This is the point of Tom DeMark trend line intersection with a vertical line. and that is 23.90. We can round it up. You don't need to use 5 decimals. It's perfectly fine if you use 4 decimals. So now we have two prices, 24.85 and 23.90. What we do next is take the difference between the highest high recorded above the trend line and the pivot point where the trend line is intersected by the vertical line. Okay, now we calculate the difference. How we do it? We take the highest high minus intersection point. The highest high was 24.85. The intersection point is 23.90, and the difference is 95. Okay. So we took the high within the trend line, 24.85, then intersection point, which is 23.90, and we just subtract from highest high. We subtract intersection point to get the price, to get the first step to price projection. It's 95. Okay, that is called the difference. That is called the difference. The difference of 95 pips becomes our price projection. Okay. Now the price projection will be 95 pips to the downside once a 4-hour candle, because Tom DeMark is saying that you should trade 4-hour time frame. Once a 4-hour candle has opened below the trend line. Now guys, this is also additional difference between classic school and Tom DeMark school. You can clearly see it here. He says that you should definitely take an open candle, not a closed candle. So let's say that this candle has closed here. He doesn't count the close, he counts the open. Okay, so that is how he does it. Okay, so the price projection will be 95 pips to the downside once a 4-hour candle has opened below the trend line. Okay, the price projection should be projected immediately following the open of the candle. So only the open is needed. That is called the signal candle, guys. Okay, that is called the signal candle. Now subtract the difference from the signal candle. That's price projection. So we will see in this example. Okay, we have 24.12 minus 95, which will give us 23.17. Okay, this is the chart, and this is how he calculates the target. Okay, so we had this chart before we started to trade. We marked the high and we marked the intersection point. We calculated the difference between high and intersection, which is 95. Then we wait for the candle to open. Once the candles open, we take the trade, and we immediately we determine target price. Target price is, so it's the difference. It's open candle minus the difference. So this is where the candle has closed. Okay, this is the candle closed. This is signal candle where the candle has opened. Okay, we need to subtract the difference from the signal candle. Difference of 95 pips here, 95 pips here, should be subtracted from 24.12, and it will give us 23.17. This is price projection where price should go. Please guys, Eric, please, do not give me your email at the moment. Please be so kind and send the email to my email requesting the indicator. I will tell you. It's tarantulafx@gmail.com. Okay, this is my email, so if you're interested to have the indicator, just send me an email. Okay, so this is the signal candle. So this is the close of the candle, this is the open of the candle, and we just subtract the difference from the signal candle. It's 24.12 minus 95. It's price projection. So this is the target. Okay? So trades are usually done on 4-hour time frame. Okay, I will give you the time to snapshot the chart, but guys, also have in mind that you need to know about your stop loss now. So you need to calculate your stop loss placement. Okay? For trades with less than 90 pip price projection, a stop loss of 50 of the price projection is used. This creates a 2-to-1 reward to risk ratio. Okay? Okay? So for trades with less than 90 pip price projection, now we are talking about 4-hour time frame, a stop loss of 50% of the price projection is used. And this creates a 2-1 reward to risk ratio. For trades with a price projection of 90 pips and a greater stop loss of 33% of calculated price projection is used. So when you use stop loss to 90 pip, okay, so sorry, this is how it should be. So equal to or less than 90 pip, you use 50% of the price projection. If you use a stop loss which has price projection more than 90 pips or equal to, let's say more than 90 pips because this is equal, you use 33%. So in this, our example, we will use 95 minus 33%. That will give us a rough 31 pip stop loss in the previous example. Okay? That is how he calculates the stop loss. Okay? 31 pip stop loss in previous example. Okay. Could you show again where we have to open trade on the example? Yes, definitely. Okay. Pay attention to this chart. Okay. And watch the price movement, please. Okay. So this is the trend line. This is where the candle closed. And this is the signal candle. So once this candle closes below this trend line, you need to wait for next candle open. This is next candle open, okay? Pay attention to this. This is next candle open, guys, okay? You see where the price is heading? So this is where you open the trade. It's called signal candle, okay? It's called signal candle. This is signal candle. This is where you open the trade. At the open of this candle, that is when you open your trade. Okay? So classic school takes patterns in consideration. Now we will talk about difference in approaches. Okay? If anything is not clear, guys, now I can repeat it again, no problems. So and please pay attention to stop loss calculation. This is how Tom DeMark suggests how you should do stop loss placement. So for trades with less than 90 pip price projection, 50% of price projection is used. For trades with a price projection 90 pips and greater, 33% of the calculated price projection is used. Now, what are the differences in approaches? So, classic school takes patterns in consideration. So, if you see this chart, classic school will tell you that you can take basically a break of this trend line also to trade. Because, in my opinion, this is a flat top ascending running triangle. Because we don't have now a full triangle. This is how ascending flat top triangle looks like. We have a running triangle. So this looks like a running triangle. When you see ascending trend line for classic school, you usually want to take breakout of this upper trend line, flat trend line. So that is how classic school does it. Classic school tells us, okay, you can go long when the price breaks, retest the top trend line. Tom DeMark does it differently. He wants to take this breakout, because this is how he call it, a demand line, and he wants to take a breakout of the demand line to the downside. Okay? So classic school always takes patterns in consideration. The question Nat is asking, entry is at open of signal candle. Yes, this is the entry, the open of signal candle. Now I don't see I don't see much logic behind that, because if this candle closes, it's normally the next candle will be right at the exact spot for the open. Maybe he takes gaps in consideration, because it's primarily used in stock market, right? So he probably takes gaps in consideration. But usually in Forex market, in normal trading conditions, we don't see any gaps. So the thing is, okay, that is the only logic behind that. Because usually when we see the candle close, next candle will be immediately open around the same price. More or less it's 1 pip. Usually it's at the price close. So he says, okay, take the entry on a single signal candle open. So if this was the open after the close, you take the trade here. So classic school takes patterns in consideration. As I say, I belong to classic school, and I see a running flat top ascending triangle here, because there is also possibility for the price to basically break out this high and then bang, shoots to the upside. He does not take those kind of things in consideration. He connects lower parts to get a demand line, and when you see a demand line, then you want to take breakout to the downside. Tom DeMark takes trend lines for determining projections. As we could see in this example, we see a high, we see intersection point, and you use a price difference to calculate the target. Okay, that is also one of differences. So those are not classic triangles, so no patterns are involved. In this example, which I'm showing you, basically you just take trend line trades. So this is not taken as a triangle. More often you will see, especially if you use the indicator which I will give you, that this indicator plots trend lines which can resemble a triangle, but those are not triangles. The only principle which you should govern yourself is trade supply and demand. This is demand line. If you see a descending trend line, that would be a supply. So you would take the supply entry to the upside, demand entry to the downside. So you don't take any triangles, although there is a resemblance to triangles. So no pivot points. Tom DeMark is not using any sort of pivot point in his analysis. He solely uses trend lines, supply and demand levels. Okay, so no pivot points are involved with Tom DeMark trend lines. Okay, guys, stop loss calculation is also different. He uses calculation which is much different. Okay, so stop loss calculation is different. He does not take any highs and lows in a classic way. As you could have seen it, he basically trades with 90 pip more or less projection. Okay, so there is also a big difference compared to classic school. Then, now in volatile markets, stop loss can be hit very often. Now there is obviously what Tom DeMark wanted to avoid, because he recommends trading on 4-hour time frame. Yeah, 4-hour time frame is, you know, it can be volatile, but it usually does not make any whipsaws. But sometimes if you want to take 100 pips, It's very hard to do it with 30 pip stop loss or even less, because usually the price, as you say, as you have witnessed very often, it can hit your stop loss and then proceed in your trend, in your direction. So that kind of approach is maybe outdated in this modern market, okay? Because he does not take highs and lows in traditional sense. I have not been trading with Tom DeMark trend lines, but definitely I will send you the indicators so you can try it yourself. You can try it yourself. But as I say, it can be pretty much different to classic approach. It's prone to fake outs, guys. It's very prone to fake outs. Okay. Again, when you use 4-hour time frame, you would not be prone to fake out so frequently. But still, even a 4-hour candle can spike down, then retraces up. So definitely you should, I recommend only 4-hour time frame trading. So because higher time frame does not have so much whipsaws. And also the difference between a classic approach and his own approach is that originally there are no additional filters for Tom DeMark trend line trading. So there are no additional filters. You don't use MACD, you don't use any other complementary indicator. So you only use his approach and how he sees the approach with his projections. Okay? So once more, I will go step by step. Then I will show you how it looks like on the chart, this indicator. Okay. The question. Yeah. Maybe it is against our strategies, but if you are making webinar about Tom DeMark trend line, so that means that it can be useful. Yes, guys, I just feel obliged because, I always want to pass the knowledge which I have to you, and I felt obliged to tell you about Tom DeMark. And I know that many of you asked me to present you Tom DeMark teaching, and I definitely am doing this now, but I need always to tell you what I think. Yes, it can be useful. I think that it can be useful. But I leave that to you to discover, because I personally, I always give you Camarilla MACD trades, Camarilla MACD analysis. So I tell you, you can do that because I know how he trades. I know what he teaches, but I personally didn't test it. I don't know in real world, in real chart how it will behave. I know the theory behind the Tom DeMark, but if you want to trade it, this is how you should trade it. Okay? And of course you should try to see if it's useful for yourself. And I know that Tom DeMark really is a well-known name in stock market, Forex. His trend lines are very, very popular. And of course, I needed to give you the knowledge, because now if I wasn't making this webinar, it would be hard for you to understand the difference. Okay? So once more, I will go through these slides. First of all, you need to locate 2 points to create a trend line. Okay? When you see the 2 points, you connect it. Okay? We will go now for downtrend. The same is you just need to do the opposite for uptrend. So to find the second point of demand line, now we are talking about uptrend, we look for the very next point of support. It has 2 candles to the left and 2 to the right that do not exceed the low of support point. Okay, this is it. This is also what indicator will show you. Okay, this is point 1, this is point 2, and those 2 points are connected from right to left. That is how Tom DeMark says. Okay, you can simply ignore this trend line because this is the valid. You will see this on the indicator, this, and that will be the sign of a true trend line, okay? So this, now in this example, you would obviously be trading this demand line, so this descending trend line. You would wait for the candle to close below this trend line, and on the next candle open you would take the trade, okay? This is how Tom DeMark says. Wait for the price to break the level, and then on the next candle close you take the trade. And of course, because this is ascending trend line, because you have two support points here, you take the breakout to the downside. Then you need to determine price projection. So take the highest high created above the trend line and mark it with a vertical line. Take a horizontal line and mark the point where the vertical line coming from the highest high recorded above the trend line intersect with the trend line. Okay? And then you take the difference. So take the highest high created above the trend line. So in this example, we see 0.1, 0.2. Then in between those 2 points, you see a high. This is the high. Okay, this is the high. And this is the intersection. So take a horizontal line and mark the point where the vertical line coming from the highest high recorded above the trend line intersects with the trend line. Okay? So this, what you see here, is the point of intersection. Okay, this is the point of intersection. Mark the prices. The price for the high is 24.85. Intersection is 23.90. Take the difference between the highest high recorded above the trend line and the point where the trend line is intersected by the vertical line. It's 95 pips in this example. So the difference of 95 pips becomes our price projection. Once the candle closes, and then the candle opens, the candle closes below, in this example, below the trend line, then immediately at the open, you do your price projection. So only the open is needed because that is the signal candle. Price projection is 23.17 for our example. And you can see that the price has been hit. For how to calculate stop loss is for trades with less than 90 pip price projection, stop loss of 50% of the price projection is used. It creates 2-to-1 reward to risk. For trades with a price projection of 90 pips and greater, a stop loss of 33 or greater, a stop loss of 33% of the calculated price projection is used. Because in previous example we had 95 pip stop loss, we used the calculation 95 minus 33% is 31 pip stop loss. So for previous example, 31 pip stop loss is used, and the target is around 100 pips, right? Goran is asking a good question. Do we use this strategy always in sell, or we sometimes use in buy? Do we always sell demand? Yes, Goran. We can use this strategy both to sell and buy. I will use. Let me show you the example. This example. Okay. So this is how the indicator is showing. So in this example, you have basically the indicator which calculated both selling from demand and buying from supply. Okay. Now the thing is, you need to wait for the candle close. In this example, what you could do is, because you have both points here, you see you have point 1, which is basically this point, and point 2, which is basically this point, and you connect it. Then you have these 2 points. This is point 1 and point 2. In this strategy, you can buy and you can sell, whichever hits first. If the candle, this is 4-hour time frame, if the candle closes here and then immediately opens, because we presume that there won't be gap, you would be trading to the upside. Okay, that is pretty much clear to you now. You will be trading that to the upside. Okay. Now in the same example, if the candle closes here and it opens immediately here, you would trade it to the downside. Okay? So this is very important. Trade on 4-hour time frame and take this approach, because euro dollar, the euro dollar, this chart is showing you how Tom DeMark would trade now. But you need to wait for the candle to close above or below to effectively trade it. Let me pause the screen for a moment. I will open the chart with the indicator attached, so I will also show you other examples. Okay. Let me use this example here. Okay, we will use pound dollar, let's say. Pound dollar. Okay. Okay, and this is, you can see, so pound dollar 4-hour time frame. If this candle closes below this trend line, 4-hour close, and next candle immediately opens below the trend line, that is the signal candle. You enter, you calculate your stop loss, and then your trend lines will probably move to calculate the target. You can do that for every single trend line. Okay, look at this. This was obviously a successful trade, although I don't think that the target has been met. Yeah, look at the target price projection, but it doesn't matter. Look how it behaved. Basically, the indicator plotted a trend line, which was this was upper trend line, and then the price broke out. This was the entry, and it tried to go to the target. I can say you cannot backtest this indicator because the indicator plots only what it sees on the current time frame. I personally, when I see these examples, I personally would recommend you to always use most recent price projection. So I wouldn't be using this example. Also on euro yen, I wouldn't be using this example because look, it's a history, it's not close. But for euro, for other example, ODCAD, I would use this price because obviously this is more recent price projection. Now the indicator cannot, you need to have a slight of that, I can say, common sense. So if Tom DeMark said that you should use recent price movements, this is more recent price movement. So in this example, I would obviously take the trade to the downside if I traded Tom DeMark. So I would wait for this candle to close below, and at the open of this candle, I would trade this. Why I wouldn't take this trade? Because it's too far away. It's not recent price action. The indicator plotted it because it doesn't know that it should be most recent. So you just use most recent price action. Okay, let's use another example. In this example, you can take basically, let's see, this price. Again, the price, this is more recent price projection, demand line. But you need to see a nice, this is not a, this is much better example, guys. This is much better example. Basically, before this happened, this could also be price projection here. Okay, and look, now the indicator plotted it here, but you see it has these icons, but below it, it connects these points, so you can see trade it to the downside, and it tries to go to the target. You can see it here. Definitely, it's look at this price projection. It's much more to the upside, but it's still a way in the history. You can plot whatever you want, and you can look at this. So you could have traded both approaches, this and this. Okay, I personally would probably traded this breakout because it had better, more recent price projections. But this price projection was obviously also useful. Okay, Goran, no problem. New Zealand yen, it's trying to go to the upside again, but definitely this is more recent price projection. Let's see now another example. Both price projections could be used here and here. Look at this recent prices. So you could do it, of course, with the help of indicator. But still, if you're not sure, because the indicator will not open the trades for you, please refer to this webinar, because this webinar will be uploaded, and the webinar use the rules which I explained you at this webinar, and try to trade it like that. If you're not sure about the indicator, I will send you, of course, if you need it. Do this traditional approach without the indicator, okay? And see how it goes. Okay, guys, you can ask any question if you want. If you don't have any question, of course, you can. We can assume that everything is clear. So I advise you, if you still, of course, want to learn about Tom DeMark, whatever, you need to demo test everything. So first of all, of course, if you want to trade Tom DeMark trend lines, do not do it live. You need to demo test it before you go it live and to see how it behaves. The indicator will help you, but you need to use the knowledge from this webinar to basically open the trades and to determine whether you would take price to the short side or to the upside. That is, of course, up to you. There is no indicator of Tom DeMark which can do that automatically for you. So that is why you would usually see both price projections here. Still, again, for you who want to take a deeper knowledge, I advise you not to use the indicator, then to use this, what I have explained you. Because this is taken from Tom DeMark book, and this is, when he did this book, when he wrote the book, basically, when he wrote the book, there was no indicator for his teaching. So for all of you who want to take a little deeper knowledge about Tom DeMark, use it without the indicator, okay? It will be, maybe it's harder, but you will get a better understanding of Tom DeMark trend lines than to use it automatically. Okay, guys, I don't see any questions, so thank you for understanding. Tomorrow we will be here with you again. And of course, there will be much useful webinars. Of course, do not forget to sign up for a premium webinar about supply and demand. You will get the indicator, which is very useful for supply and demand. That is only reserved for premium, for live Admiral Market account holders. And do not forget to sign up for weekly Forex recap. We had a huge number of pips this week. I will be showing you that on Monday. So, guys, thank you, and I will be here with you soon. Do not forget to trade safe, as always. Cheers and trade safe.